Welcome to Talk Tickers. Today, we're diving into Intel's Q4 2025 earnings call, and boy, is it a head-scratcher. We've got a classic Wall Street paradox on our hands. A company beats expectations, but the stock gets absolutely hammered. So what's really going on here? Let's get into it. So, let's start with the central puzzle from this whole report. On the surface, things look pretty good, right? I mean, Intel delivered a solid beat on both earnings and revenue. You'd think that would be cause for celebration. So why on earth did the stock plunge after hours? That is the big question we really need to answer. And we're not talking about a small dip here. The stock fell by roughly 13% in after-hours trading. And this wasn't just some random panic sell-off. This was the market looking past the headline numbers, digging into the full report, and crucially, paying very close attention to the company's outlook for the future. Okay, so let's really get into the weeds here. This whole thing is basically a tale of two reports. It's like one story is about what just happened, which looks great, and a completely different, much scarier story about what's coming next. First up, let's talk about the good news from Q4. Their non-GAAP earnings per share, the number that really shows profitability, came in at 15 cents. Wall Street was only expecting 8 cents, so they beat that by a whole 7 cents. That's a solid beat. And it wasn't just on earnings. Revenue also beat expectations. They brought in $13.7 billion, which was a good $300 million more than analysts were predicting. So you see what I mean? On paper, this quarter looked fantastic. And boom, here it is. This chart right here tells you everything you need to know. Look at the left, the Q4 beat we just talked about. Looks great. Now look at the right. That's the guidance for Q1 of next year. It's a disaster. They're guiding to basically zero profit when Wall Street was expecting a nickel. And revenue? Way below what anyone was hoping for. This right here is the reason the stock got crushed. And you know what? To his credit, the CEO didn't even try to spin it. Lip-Bu Tan came right out and said it. In the short term, I'm disappointed that we are not able to fully meet the demand. That's a pretty candid admission, and it set a really cautious tone for the whole call.
So this really brings us to the crucial question, right? What is actually causing this disconnect? Is this a good problem to have or something more serious?
Well, everyone, from analysts to the company itself, honed in on the same thing. This is not a demand problem. Let's be really clear about that. People are lining up to buy their chips. The problem is it's a supply problem. Intel just can't make enough of them, particularly the ones everyone wants most.
And this chart really paints the picture. You can see exactly where that crazy demand is coming from. The data center and AI group is up a whopping 9%. Meanwhile, the old school client computing, the PC stuff, is actually shrinking. So the one area that's absolutely on fire is the exact area they can't supply enough for. Ouch.
Management actually gave this situation a name. They're calling it the supply trough. Basically, they're saying that the first quarter of 2026 is going to be the absolute bottom for them in terms of being able to ship products. They've used up all their safety stock, and they flat out admitted they misread just how massive the demand surge was going to be.
Okay, so with the short term looking, pretty rough, management really had to pivot the conversation. They started pointing everyone's attention to their long-term plan, their manufacturing roadmap, as the way out of this mess.
And look, their whole comeback story is riding on this roadmap. They've got Intel 18A shipping now, but even the CEO said the yields are, and I'm quoting here, still below what I want. That's a huge red flag for execution. And the next big thing, Intel 14A, well, we're not going to see that in full swing until 2028. So this isn't a quick fix. This is a long, tough slog to get their manufacturing back on track.
So let's put it all together. What does this mean for the stock going forward? What should you be watching for? Here's our take, our playbook for investors.
All right, so at Talk Tickers, we're slapping a market perform rating on this. Look, the stock had a monster run-up before this report, which set the bar way too high. The stock price has now been reset to a more realistic level, but we just don't see a lot of upside in the near term because of these supply problems. It's really become a prove-it-to-me story now.
So if you're an investor, how do you play this? Well, our thesis is pretty simple. The stock is probably range-bound for a little while. The upside is capped until they can prove they can make enough chips. Because of all this uncertainty, you're going to see a lot of volatility. One way to think about it is a strategy where you sell call options against a long position. The goal there, you're basically collecting income from that high volatility, getting paid to wait for management to actually deliver on their promises.
This is not financial advice.